Hello, my name is Raul Garcia, and the subject of this presentation is the International Financial Reporting Standards, or known as IFRS. I'll discuss what IFRS is, its importance, history, benefits, challenges, and the future of international reporting. So, what is IFRS? We define IFRS as accounting standards issued by the International Accounting Standards Board, also known as IASB, that are designed to provide a global framework for financial reporting. The goal is straightforward: to ensure that financial statements are transparent, comparable, and consistent across international boundaries. IFRS covers areas like revenue recognition, leases, financial instruments, and fair value measurements. Today, over 140 countries either require or permit the use of IFRS, making it the leading standard for financial reporting worldwide. Some of the key adopters include the European Union, Australia, Canada, and Japan. Although the US uses generally accepted accounting principles, or GAAP, it also allows for IFRS reporting for foreign matters. Why is IFRS important? IFRS is crucial in today's global economy. A few reasons why it matters is: first, it enhances transparency. IFRS ensures that financial statements provide an accurate and reliable view of a company's financial position and performance. This transparency builds trust amongst investors, creditors, and other stakeholders. Secondly, it promotes comparability. Under IFRS, financial statements are standardized, making it easier to compare companies across different countries. This is particularly crucial for multinational corporations and investors operating globally. Third, it facilitates global investment. A uniform set of standards lowers the barriers that hinder international investing. By using IFRS, companies can attract a broader pool of investors who rely on consistent reporting to make informed decisions. Lastly, it supports economic growth. When companies and investors operate on a common financial language, it fosters economic development by reducing inefficiencies. So let's talk about some defining features of IFRS and how they differ from other accounting standards. First, it is a principle-based approach. Unlike the rules-based approach of some systems, like US GAAP, IFRS emphasizes on principles. This allows companies to apply professional judgment while preparing financial statements, offering flexibility to address unique circumstances. It also ensures fair value measurement. IFRS relies heavily on fair value measurement, ensuring that assets and liabilities are valued at their current market value. This approach reflects the true economic realities of a company. It also focuses on substance over form. IFRS prioritizes the economic substance of transactions rather than their legal form. For instance, a common example is that it recognizes a lease obligation as a liability, even if it's not legally classified as a debt. What are the benefits of adopting IFRS? Adopting IFRS brings several advantages for businesses, investors, and economies. To outline a few, for businesses, it provides global access to capital. Financial statements compliant with IFRS are recognized worldwide, enabling easier access to international markets. It is also cost efficient. Multinational corporations save cost by preparing a single set of financial statements rather than complying with multiple local standards. like preparing IFRS and GAAP compliant financial reports. It also aids in improved decision making. IFRS provides a clear picture of a company's financial health, enabling better strategic decisions. Now, for investors, it provides consistency. Investors can compare companies operating in different countries more easily, and it enhances confidence. Transparent reporting under IFRS builds investor trust, encouraging greater investment. For individual economies, it aids in the integration with global markets. Countries that adopt IFRS align themselves with international financial systems, attracting foreign investment. And it also simplifies regulation. Regulators benefit from comparable reporting standards, reducing complexity and redundancy. Before its transition to IFRS, it was originally known as International Accounting Standards, IAS. The International Accounting Standards Committee, IASC, was established in 1973 by professional accounting bodies from 9 countries: Australia, Canada, France, Germany, Japan, Mexico, the Netherlands, the UK, and the United States. The aim was to develop international accounting standards to harmonize global accounting practices. Over time, the IASC issued a series of international accounting standards, which were widely adopted but not universally applied. Transition to IASB. In 2001, the IASC was restructured and replaced by the International Accounting Standards Board, IASB. The IASB assumed responsibility for setting global accounting standards and committed to replacing IAS with IFRS. As stated earlier, the focus of IFRS was on principle-based standards, reflecting the economic substance of transactions as opposed to the more rule-based approach of other systems, such as US GAAP. Now, I wanted to discuss a few milestones in the development of IFRS over the last few decades. In 2002, the European Union adopts IFRS for all listed companies. In 2005, it made the transition to mandatory implementation of IFRS in over 25 European Union countries. In 2010, IASB and FASB collaborated on convergence projects to align IFRS and US GAAP. And finally, in 2014, IFRS Foundation established a regional office in Asia. While IFRS offers numerous benefits, there are challenges in its implementation. For example, it is complex. IFRS relies on a principles-based approach requiring professional judgment, which can lead to inconsistencies and misunderstandings. Some IFRS standards are highly detailed and difficult to implement. Another challenge is the cost of transition. Transitioning to IFRS requires significant investment in staff training, new accounting software, and external consulting services. There are also ongoing compliance costs. Maintaining IFRS compliance can be costly due to continuous updates, training, and potential changes in business processes. Additional challenges also include cultural and economic differences with adaptation to local practices. The global nature of IFRS might not fully reflect the specific culture or economic conditions of certain regions, leading to additional implementation challenges. There might also be resistance to change. Employees, management, or regulators might resist the transition due to unfamiliarity or perceived disadvantages. IFRS might not always align with local business practices or economic realities. For example, Fair value measurement can be problematic in markets with limited price transparency. Now, there are several steps an organization can take to mitigate some of the challenges that come with transitioning to IFRS. First, an organization could develop a transition plan. They would outline a clear roadmap, including timelines, resources, and milestones for transitioning to IFRS. They would need to engage with experts, work with consultants, advisors, and auditors experienced in IFRS. Very importantly, they would need to invest in training, ensure all stakeholders understand the implications and requirements of IFRS, and they would need to communicate with these stakeholders, proactively inform investors, analysts, and regulators about the transition process and its impact. We can clearly see that the future of IFRS is dynamic. It is continuously reshaped by evolving business environments and stakeholder needs. A few of the future trends include sustainability in reporting. Now, the IFRS Foundation has established the International Sustainability Standards Board, or the ISSB, to develop global standards for sustainability disclosures. These standards will complement financial reporting, addressing the growing demand for transparency in environmental, social, and governance issues, or ESG issues. For digital reporting, IFRS will likely adapt to ensure financial data is accessible and machine readable. In the future, addressing intangible assets like intellectual property, brands, and digital assets are critical. Future IFRS standards may provide better frameworks to recognize and value these assets. There also needs to be future comparability with other standards. Efforts to bridge the gap between IFRS and other standards, particularly US GAAP, will continue, fostering greater global consistency. There are other sector-specific standards, such as industries like technology, healthcare, and renewable energy, that IFRS may introduce tailored guidelines to address specific financial requirements. As we become members of the financial sector, such as accountants, auditors, or investors, it is crucial to stay informed about developments in IFRS. It would benefit us to 1. Invest in training and education to understand IFRS requirements. 2. Stay updated on new standards and amendments issued by the IASB. And 3. Advocate for policies that support transparent and comparable financial reporting in our organizations and our country. When you go to the ifrs.org website, you can find information on standards and interpretations, news and updates, educational resources, as well as jurisdiction profiles. You can access the complete set of IFRS standards and related documents. You can stay informed on the latest developments, consultations, and projects. You can find workshops, webinars, and training for accountants, auditors, and other financial professionals, and learn details relating to IFRS adoption in various countries. In closing, the IFRS Foundation plays a crucial role in shaping the future of global financial reporting by fostering transparency, consistency, and comparability across borders. Its standards empower investors, regulators, and businesses to make informed decisions, driving trust and efficiency in international markets. As the global economy becomes increasingly interconnected, the adoption and application of IFRS continues to enhance the clarity and the reliability of financial information, supporting sustainable growth and collaboration worldwide. I hope you now know a little bit more about IFRS and the reporting system. All information was retrieved from ifrs.org. Thank you for watching.